Hey, what's up? I'm Russ, and this is Dapper Dividend. So, lately I've been wanting to focus my attention more toward not turning a blind eye on companies that have a lower yield, maybe something under 2.5% or under 2%, as I've been prone to do. Because if these companies can grow their dividend really quickly and they have really nice growth, then that is awesome for us as dividend investors because over time, those fast dividend increases will really start to compound and we will have a much better and bigger yield on cost. So I have 5 companies for you that have freakily fast grown their dividend over the last few years, and they actually have very low free cash flow payout ratios, which means that they should easily be able to sustain the current dividend and continue to have some really hefty and nice dividend increases. So let's get on with number 1. First up is Tractor Supply Company, ticker TSCO. They supply all the kinds of things that people that live in the heartland and farmland and rural areas need on their daily lives and journeys, and they got chicks, man. Right off the hop, they have a dividend safety score of 68, which Simply Safe Dividends considers safe. Their last dividend increase was 77% in January of 2022, and that current yield is only 1.64%. Now we see very big numbers here as of late, just a really steady and nice slope upward starting in about 2010. The last 10-year compound annual growth rate is 25%, 18% in the last 5 years, and then that massive 77% dividend increase from TSCO. Currently paying $3.68 per share per year, which is 92 cents per quarter, and they have been growing that dividend for 11 years. The dividend yield is about 18% above the 5-year average. The PE is a little bit above their 5-year average, so in that regard, you'd definitely be paying a premium, a little bit toward the high end of their 52-week price range, and they are way over the average PE of the consumer discretionary sector. And as I said, low payout ratio, only 47% of free cash flow. I like looking at free cash flow payout ratios more than earnings per share. I love seeing this. They've consistently been buying back their shares, and their sales have also been consistently going up and to the right. Really solid numbers on return on equity and return on invested capital, which kind of gives us a flavor of how management is handling that money. They're doing a fantastic job. Now, the only bugaboo here is that they have a little bit of debt, but with $51.48 of operating income to cover every $1 of interest expense, as the interest coverage ratio, the ICR ratio tells us, they have no problem paying the interest on that debt. Next up is ticker APH, which is Amphenol, and what they do is they interconnect the high-end technology systems from all across the world, all across industries. Check that out, from automotive to commercial aerospace to industrial, mobile devices, military. They are pretty much everywhere. Really interesting company that I think you should look into. And you can see here some of the flavor of products that they make, from sensors to connectors to raw cable. Amphenol has a dividend safety score of 87, only a 1.08% yield. But again, I'm trying to get on board with looking for low yields, but if they can sustain and grow those dividends quickly, then I want to invest in more companies like that, which I actually did in one of them, as we will see. So they really started ramping up their dividend coming out of the recession right around 2011. Dude, the last 10 years, they have had a CAGR of 45%. 17% the last 5 years, and last year they had a 38% increase in their dividend, so really big up and to the right mountain, and they have been growing that dividend for 10 years. So they're currently paying 80 cents a share, which is 20 cents a quarter, and that current yield of 1.08 is about 14% above the 0.94% dividend yield. PE is just about even with their 5-year average, and they're right smack dab almost in the middle of their 52-week price range, and their PE is also above the information technology sector average. Only a 32% free cash flow payout ratio. Now, they had been buying back their shares, but it looks like they jumped from 615 to 626 in 2021, but their sales have just been growing really nicely up and to the right as well. Management been doing good with that money. 27% return on equity, 18% return on invested capital. Their debt doesn't look too bad, and that beautiful number I love seeing, an $18.77 of operating income to cover every $1 of interest expense. I'm going to beat that into your heads. The ICR number, I think, is a really telltale number that lets us feel good if a company experiences some headwinds or interest rate hikes, if they're going to be able to keep paying the interest on their debt. Next up is Amdocs. Amdocs, ticker DOX. And what Amdocs does is they develop and provide software and service to telecom companies. And you can see from the video, they're all about the cloud and 5G and helping businesses that are in the telecommunications space improving and just being able to grow their business and operate smoothly. They do have one of the flashier websites, so if you're thinking about Amdocs, I would strongly recommend, as you can see, popping onto their website and taking a look at it. It's pretty darn cool. Now, Amdocs does get a dividend safety score of 90, which is very safe. Current yield is 1.91%, but they grew that dividend 9.7% in February of 2022. 9-year dividend growth streak, so they are almost a dividend achiever, which is when a company has been paying a growing dividend for 10 straight years. But the last 5 years compound annual growth rate is a very, very healthy 13%. Current dividend, $1.58 per share, which is 39.5 cents per share per quarter. The current dividend yield is about 6% above their 5-year average, so as they say, it's about in line. Same thing with their PE, so all just pretty much right in line. They are toward the high end of their 52-week price range, but they are below the current information technology PE sector average. Free cash flow payout ratio, only 37%, super low. Now, their shares outstanding have been decreasing, and they're at 128 million shares currently. The sales have just been really stair-stepping up nice and to the right. Nothing too crazy, but this looks really consistent and sustained. Management has been doing pretty well with the capital that they have, and they pretty much have no debt, very healthy balance sheet, and the ICR, $24.06 of what? Operating income to cover every $1 of interest expense. Now, this is a company that I did just initiate a position into, which is Lowe's, ticker symbol LOW. I think most of you know Lowe's. They are a hardware store, so we don't really need to get into that. But man, just looking at this website, I want to go shopping, don't you? All right, so check it out. Lowe's has a dividend safety score of 93, which is very safe. But look at this. Last dividend increase of May of 2021 was 33%. The current yield is 1.56%, which is actually a touch below their 5-year average. I mean, look at this. The last 20 years, as I talked about this actually on the last live stream because Ryan Williams brought it to our attention, 24% increase compound annual growth rate the last 20 years, last 5 years, 18%, and the latest again was 33%. They have been growing that dividend for 59 years, so Lowe's is a dividend king. That's currently paying $3.20 per share, which is 80 cents per share, so they're coming up here for another dividend increase, and this is why I wanted to get that position going and initiated, because I want to get in on this next really healthy dividend increase. So we see that their current yield is about 12% below the 5-year average. That's okay because they're really growing it nicely, but the PE is a little bit below their 5-year average. They're about in line, but a little bit above the consumer discretionary sector. But check out their price. They're toward the lower end of the 52-week range, where it's currently at $204.87 right now. Free cash flow payout ratio, only 25%. That it just leaves a ton of room to keep growing that dividend and having some nice increases. So that is nothing. They've really been buying back shares quite a bit, all the way down to 699 million shares. At this point, they're going to run out of shares to buy back, but the sales, the total revenue coming in just keeps going up and to the right. I couldn't find any reason why that it shows their current return on equity is negative 500%. So if they bought something or took on a bunch of debt, I did not dig that deep. If you do know, I'd love it to hear and share with everybody. But the return on invested capital, 50%, just... I mean, that is strong. All across the board, their numbers look really good, except again for that debt. They do have a little bit of debt, but can they cover it? $13.66 of operating income. For every $1 of interest expense, they can cover the interest on that debt. Lowe's just looks really, really solid to me. And last but not least, we have Snap-on Tools, ticker SNA. They make tools, high-end tools, diagnostics, different things in the tool industry. This is the industry that I know. The last two actually talk about your circle of competence. Lowe's and Snap-on, that's in my wheelhouse. They have a bunch of different brands, as we can see here, which, Blue Point, if you don't know, Blue Point is like the lower end cheapy tool that they make. And we save the best for last because Snap-on has a dividend safety score of 99. Their last dividend growth was 15% in November of 2021, and that dividend yield is 2.75%. And this is another company that I am about to initiate a position into, looking to maybe consolidate like Volkswagen, some of the other companies that are not core positions, because this looks like a really solid company to me. They've been growing that dividend for 12 years. It's been uninterrupted for 29 years. The last 20-year compound annual growth rate, a very healthy 9%. The last 5 years, 15%. And then there's that 15% we just saw in November of 2021. They're currently paying $5.68 per share per year, which is $1.42 a quarter. Their current yield is 18% above the 5-year average. And they are actually below the 5-year PE average. And look at the 52-week range buried all the way to the left. Now, they don't move a lot, only between 202 and 255, so there's not a lot of volatility with Snap-on. And they are way below the industrial sector average PE. More of the same with these. Free cash flow payout ratio, 31%. Now, they had been buying back shares. They were at 54.8. That ticked up to 55 million shares. But their sales have kept going up. Return on invested capital and return on equity are both solid. 20% return on invested capital. That's very nice to see. Not a lot of debt. Very clean balance sheet that they have. Now, I take these zeros with a grain of salt because I would need to dig into that to verify that, but I say not a lot, we'll go with it. And the interest coverage ratio, 21.48, just a solid company all around. All right, I would love to know what you think of these companies. Do any float your boat? Do any of them wet your whistle? Would you consider investing in any of these, or do you already invest in any of them? We would love to hear. Share it with the community. Share any of your favorite high-flying, freaky fast dividend growth companies. And hey, if you're interested in hearing about all the stocks that we share here on the channel, look at this little box next to my head. Click that little box. And if you go there, I will talk to you there.